Trading the euro and the dollar is like navigating a wet mountain road at night. It's a relentless, high-speed environment where the only way to stay on the road is to understand how much momentum you're carrying into every turn. Professional traders measure momentum using the Relative Strength Index, or RSI. You can think of it as the RPM gauge on a car's dashboard. The math behind it is essentially a way of weighing the intensity of the upward pushes against the downward pulls over the last 14 steps the market took. It results in a score from 0 to 100 that shows who is winning the struggle. Just as an engine's RPM tells a driver exactly when to shift gears, this score shows whether a market trend is accelerating or preparing to stall out. Most people start by learning two boundaries. They're told a score of 70 means the market is overbought, and a score of 30 means it's oversold. The trap is treating those numbers like guaranteed reversal points. Beginners often assume that as soon as the line hits 30, the price has to bounce back up. But during total panic, price falls so hard the momentum gauge smashes through that 30 line, staying pinned there while the market crashes. Trying to trade that standard setup during these moments is like driving a sports car on a flooded road with basic tires. The dashboard might be warning you, but you've already lost control of the vehicle. Relying on rigid, unchanging settings in a dynamic market is a path to failure. To navigate this terrain, your tools have to adapt to the road. There are moments when the outward price and the internal momentum tell two different stories. It's like a car slowly rolling backward down a hill, even though the engine is revving up to surge forward. The euro's price drops to a steep new bottom, looking like a total collapse. But watch the momentum gauge. During that same drop, the score didn't fall as far. It's trending upward. Downward pressure dries up as large investors quietly buy, creating hidden strength. This signal is even stronger when it happens at a price level where the market has stopped falling and turned around before. It acts like an X-ray for the market, separating the surface appearance of a crash from the actual momentum of a reversal. However, an engine revving up is just a warning. It is not an immediate command to press the gas pedal. You have to wait for a tangible shift in direction. You need proof that the momentum is moving the price before you risk any capital. Look for a specific shape on the chart, like a bar with a long tail that shows the price was pushed down but immediately snapped back up. This shows that buyers are now in control. The moment to enter the market is when that bar finishes forming and the momentum line officially crosses back up over the 30 boundary. Coupling that hidden momentum with physical proof of a turn prevents you from jumping in too early and protects your savings. You can make this even more effective by adjusting the gauge to match how fast the market is actually moving. When the major markets in London and New York are both open, the price swings can be chaotic. In these sessions, the standard 70 and 30 settings are too narrow and will trigger constant false alarms. During active hours, expand boundaries to 80 and 20. This gives the momentum line room to move without false signals. In quieter sessions, momentum is lower. Bring boundaries back to 70 and 30 to stay sensitive to smaller moves. Professionals use a measurement called the average true range, which simply tracks how far the price usually travels in a single jump, to decide exactly where these boundaries should be. Dynamically matching your settings to the current environment is the difference between guessing and trading with a clear plan. It forms a complete cycle. Measure how fast the market is moving, adjust your gauge, watch for the hidden turn, and wait for price confirmation. Open your charts and see how the price has moved over the last hour. Start adjusting your momentum boundaries to fit that specific rhythm. As we move forward into 2026, remember that trading success comes from continuously matching your tools to the market's changing rhythm.